Hey, it's Tom, and in today's video, I want to answer a simple question. What's next for the stock market? What's the future for growth and tech stocks? And should you rotate your portfolio towards more classical stocks like airlines, hotels, infrastructure, and whatnot? It's going to be a quick little video, 5, 10, 15, 20, 30-minute stops. I'm just kidding. It's going to be a quick video. Don't worry. And I'm just going to give you the highlights. You know, I like to get straight to the point. I don't like all this nonsense and mumbo jumbo. So let's get started right away. In case this is your first time here and you lasted all the way in this video, my name is Tom. I used to be a senior financial analyst. Now I'm a full-time YouTuber talking to you about the stock market, the financial world, and economics. And in today's video, I want to share with you my perspective as far as what's next for the stock market. But for that to happen, you have to take a journey with me into the depths of our actual economy, because the stock market is just a reactionary device to what's going to happen in our economy. And I know that sounds bombastic and abstract, but just bear with me for 30 seconds. If you can actually read the economy as a chessboard, you can see the moves going forward, and I kind of see it, and I'll share with you at least my vision of what's going to happen. Now, of course, we're playing against God, and when you play against God, I mean, God is undefeated, so it's just the projections. We make plans and God laughs. This is not a religious statement. It's just, you can call it God or you can call it fate, whatever your belief is, right? So here's the thing. Right now, we are post one of the biggest tech bull runs we've ever seen in the history of mankind. If you held any sort of tech stocks, you saw a huge upside over the course of the last year. And that's why probably most of us have a completely unbalanced portfolio where we have a lot of tech stocks, a lot of growth stocks, and not enough rotation stocks. And it's only natural because it was the smart play so far. The question now that we had the tech dip and then it bounced and then it dipped again and it's kind of volatile right now. So there's an opportunity in this market to basically rotate almost for free. You can rotate some of your portfolio without paying a huge cost because the tech kind of bounced back and now it's bouncing around pretty much at cost. So should you do it? Should you write it out? What's next? Is this temporary? What's going to happen? So I'm going to share with you my vision. The way I see it is that basically the stock market is just a derivative of what's going to happen with our inflation numbers. And I explained this in my previous videos. And in this one, I'm going to keep it brief because I don't want to repeat myself too much. But essentially, the way we evaluate stocks is based on this old concept called discounted cash flow. We essentially estimate or guesstimate what would be the future cash flow of a certain business based on pre-existing data and, of course, our own subjective assumptions. And the one thing that can dramatically change the numbers that you get in your DCF, discounted cash flow valuation model, is the interest rates you're using for the discount. A discount is essentially when you bring back future cash flows all the way back to today, 4, 5, 3, 2, 1 years, whatever. The higher the interest rate is, the lower the amount you get today versus the future expected returns. Now, here's the thing. What happens if inflation goes up? If inflation goes up, the main way for the Fed and the US government to basically chill the market a little bit and slow down the inflation is by raising interest rates. When you raise interest rates, you essentially decrease consumption. You incentivize people to save their money, right? If I'm giving you higher interest rates on putting your money in the bank, you probably are not going to be buying the same amount of commodities, electronics, and nonsense. A lot of your money will go to savings. And that way, there's going to be less competition for the same amount of goods, which will not drive the prices as much as it is today, which is a crazy situation where we have all this money being printed, giving away for free, and the interest rates are literally zero, so nobody's saving, everybody's spending hard, and there's a lot of competition for commodities, and you can see it in raw materials. In fact, you can see it with stock prices. There's a lot of indicators of a potential inflationary attack on our economy. Now, that attack is not being charged by some evil warlord. It's just the way the world works. When you have a lot of money in the system, when you have zero rates, people are spending money, inflation goes up. Now, here's the question for you. If we're expecting interest rates to go up, we're expecting stocks that have more money in the future compared to what they have today to actually go down in valuation. Let me explain. If I'm looking at a cash flow positive company, let's say a utility company or an energy company that makes its money today, doesn't have any major upside, any major growth, that stock or that company will not have any major fluctuation in its valuation based on the interest rates because all of its money is right here now. I'm not assuming future returns, and I don't have to bring them back to today. Now, imagine right now we're talking about a company that has a product that's coming out in 3 years, but it's completely revolutionary. It's about to revolutionize the whole industry, and it's going to go massive, kaboom, right? But it's in 3, 4, 5 years. In that case, that kind of company will take the massive hit in valuation because the future massive upside it has gets discounted all the way back to today at a higher rate. Now, those are the companies which will suffer from a higher interest rates. Now, what's going on with the economy right now? How likely will the interest rates going up is? And here's my answer to you. What's going on in the economy right now, and my pitched voice for some reason just decided to come out, I don't know why, is essentially we have these processes that cannot be undone, cannot be stopped. Essentially, we have reopening, we have recovery, vaccinations, pretty much everything is going towards some sort of a recovery mode. And of course, in this situation, there's one thing that's bound to happen. More people will get back to work, they'll spend more money, and more growth will happen in our economy. And as the economy grows, especially post-crisis, you can look at what happened after World War II, for example. When an economy is coming out of a crisis, it's a massive race, it's a boom. And when these booms happen, the inflation is almost bound. It's inevitable the inflation will go up because it's part of growth. And in this scenario, of course, if this actually happens, which I think it will, if the economy goes boom and the inflation goes out of control, the Fed will be left without any choice. And even though right now we have probably the most dovish Fed chair that I've ever seen in my life, I know Jerome Powell is not interested in raising interest rates almost to the point of oblivion. At some point, I think he'll have no choice. Of course, when that choice gets taken away from him because inflation rates are so high, he'll have to raise interest rates to kind of stop and chill the market. Once that happens, a lot of these tech stocks will take a massive hit, no matter how good these companies are. Now, that's not a reason in itself to sell stocks you actually believe in, or I should rather say companies you rather believe in, right? Because if you believe in the companies such as Tesla, such as Palantir, such as BNGO, such as BCRX, there's a lot of companies you believe in, like it's CrowdStrike, Disney, Amazon. All these companies, if you believe in those companies, it's not a reason to sell. However, if you don't rebalance your portfolio and add some recovery stocks, then your portfolio is going to look like he ran through a truck, dumped it in the sewer, came out, ran through a brick wall, pretty much what my grandfather does every Sunday after he has a few. Now, that's a whole different story for another video, but in this video, we're going to stay stocks. Now, here's the thing. How do you rebalance your portfolio? How do you add stocks that will mitigate this effect? And in fact, I talked about it quite a lot. Now, for my patrons, you probably saw me tell you, hey, there's a company called DHIL, which is essentially like a correlation -1 to ARK. They invest in everything that ARK stands against, so to speak. DHIL pretty much invests in Abbott, in Berkshire Hathaway, PepsiCo, pretty much all of these classical stocks you probably want to be in. And I'm not saying you should or should not get DHIL because this is not financial advice. I'm just sharing my opinion, which might be inaccurate or wrong. You do have to do your own research, allegedly, blah, blah, mother effing blah. But all I'm saying is that companies like DHIL would be a good hedge against what I just described as far as sweeping the rug under you and taking your portfolio down. Now, DHIL is one example. There's a lot of them out there. You have to start thinking about what classical companies you can put your money in without it being already overpriced because of FOMO. Now, that's why I would not invest in airlines and hotels and energy and utilities, because those have already a lot of people who ran through them way before it was relevant and jacked up the price to prices that I don't want to invest in. However, I do have my theory as far as how the reopening would look like. And based on that theory, I think there's a lot of hidden gems in places you never thought to look at as far as good rotation stocks. Now, this might be surprising for you, so keep an open mind. So Tom, where do we find these hidden gems, rotation stocks that nobody's talking about? Well, for that, you got to take a trip with me into my reality, right? We all have a vision about what the world would look like post-pandemic. What would the post-recovery economy look like? What would our life look like? And my theory is that we're not going back in time where people drive an hour each direction to work, or going to the cinemas every week, or flying around in jets just for board meetings, or going out to a gym instead of working out at home with their Peloton bike. I have my ideas about the fact that we as a society learn how to be more efficient from home. For example, we as employees learned, well, it's much simpler to work from home at least part of the time, at least once or twice a week. I'll be saving 2 hours a day, which I can actually put into work and make my job even easier and make more money for my boss. The boss doesn't have to spend as much money on office space, on parking, on reimbursing me for my gas. There's a lot of efficiencies that we kind of learn to utilize that we probably would not want to give back. For example, a major company that has people and executives flying around just for board meetings, which you can do in Zoom and save millions. How about flight fare? There's a lot of things here. I'm not saying that people will stop flying when, people will still go outside. But I'm saying there's a lot of it which will get accelerated. In this new world, you work from home more electronically. In this world, you consume media at home more. Instead of going to the cinema all the time, some of the movies go direct to streaming like they are today. Instead of going to the gym, wasting an hour and a half to drive there and back and just, put yourself at risk, God forbid, if there's still COVID concerns, you can work out at home with your Peloton bike or a treadmill, whatever, right? Instead of doing all of these inefficient things, we're going to be doing a lot more stuff digitally online. And given that, you have to assume that the most exciting and yet unforeseen industry to be in right now is cybersecurity. With this new trend being accelerated, which started way before COVID, of everything going online, retail, brick and mortar slowly dying, now get accelerated. Everything is going much more online than it already started before the pandemic. The pandemic did not create industries, it just accelerated existing trends. With everything going online, as far as employment, recreation, exercise, and all that good stuff, cybersecurity becomes super, super important, because if you just remember what happened with SolarWinds, that is a Class A felony. As a business, if you get hacked and your client's information is out there, it's literally a death sentence for your business. It's very, very unacceptable. We as clients expect our data never to be hacked. And if some company allows that, we're not going to forget for a very, very, very long time. And the companies know that. I think that CrowdStrike, for example, I think they grew in revenue almost 90% from last year. They're accumulating a market share like it's in 1954. I mean, this is crazy. And CrowdStrike is just one example of a company that nobody thinks of as a rotation stock, and yet I am heavy in. There's a lot of similar companies such as Fortinet, such as Mimecast. Everything that has to do with cybersecurity will have a huge boost post-recovery. Even though it sounds crazy, think about it. Now, the other two stocks I want you to consider as far as post-recovery sleepers, let's call them this way, right, is Disney and Amazon. Now, Amazon, I've talked about extensively before. I think an Amazon post-recovery with the whole collapse of brick and mortar e-commerce is going to go berserk, especially with how AWS is going right now with their collaboration with Palantir. I think Amazon is going to go to $4,500 per share. I've spoken about it. There's a whole video I did about it. You can go check it out on my channel. I'm not going to repeat myself. Disney is another great example of a rotation stock that nobody's talking about. In fact, Disney just lost, I think, 3 or 4% in the last 5 days in its share price, bringing it back a little bit to earth. And with all the physical assets of Disney, which will reopen the parks, the recreations, it's going to bring in a lot of money for Disney. Not to mention the fact that Disney just signed a massive deal with the NFL. I mean, the Disney Plus service grew by 100 million users in just 16 months. That's insane. And especially when 50% of these users don't even have kids. When you think about Disney, well, you would think, well, a lot of families, half, Eddie, half of these 100 million have no kids. I think Disney Plus is going to be the winner of the streaming service in the next 5 years. They're going to be number one. Not to mention the fact that Disney has a lot of physical assets, which will bounce it right back. So Disney is an unexpected recovery stock that has a lot of digital in it as well, much like Amazon, much like CrowdStrike. These three I'm really bullish on as far as my recovery stocks. I'm not going to be buying hotels and gas companies. So that's what I'm doing. It's my opinion. It's my due diligence. I'll see you guys in the next video. And before we do, a huge thanks to our channel members and our Patreons for making this possible. We'll see you guys in the next video.